Hello and welcome to Portfolio Matters, weekly markets checklist, week 134. And it's been another dramatic week in bond markets. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What do we have this week, Keith?
First of all, some housekeeping. There is no PM next week, I'm afraid, as I'm off to run the Amsterdam Marathon. Normal service will resume the following week. Okay, news this week. Well, contrary to our predictions last week, the US government did not shut down, and there was a last-minute deal to keep the US government running until November the 17th. However, it came at the cost of House of Representatives Speaker Kevin McCarthy's job. He was deposed by the Democrats and some rebel Republicans. Now, there is no speaker. They're holding elections for them, but we're just going to have to wait and see what happens. This could actually make a deal much harder to achieve. So the US government keeps running until November the 17th. Now, the Ceyhan pipeline between Iraq and Turkey, which we've discussed previously, is due to reopen this week, and that will add potentially 500,000 barrels a day to global oil supplies, and is very good news. OPEC Plus output actually grew in August by 120,000 barrels a day due to increases from Iran, Iraq, and Nigeria, and that's despite the Saudi cut. The World Bank has downgraded its Asian growth forecasts next year to 4.5%, and they're saying China will grow at around 4.5%, i.e. below the 5% target. And we will show you that this week has seen an absolutely enormous drop in global oil prices, that everyone was expecting them to head north of 100. In fact, they've collapsed the other way. Now, that appears to be in part due to the EIA stating that US gasoline demand has fallen to a 25-year seasonal low. We'll discuss that further, but also Russia has lifted its diesel export ban. All of that has added to concerns about the balance between supply and demand and sharp sell-off in oil prices. Okay, so charts related to the news. Well, this is OPEC Plus, and you can see that actually they have cut, and the cuts are holding from Saudi, but it's just Saudi. Russia seems to have held production steady. So this is the World Bank's forecast for Asian growth. They've been cutting it as the world economy slows, and there have been downgrades to Chinese growth forecasts from everyone. So this is the charts that spooked oil markets. This is US gasoline demand, which has hit a 25-year seasonal low. The question is that structural or is that idiosyncratic? Now, various people have been saying that the US gasoline demand will be in a structural decline because of lower commuting and the transition to more electric vehicles. But if you look at road traffic, and that's the blue line, then it hasn't fallen as much as implied gasoline demand. And so what may be happening is that implied gasoline demand comes from petrol stations. So it's not the amount sold from the petrol stations to the cars, it's the amount sold from the refineries to the petrol stations. And when oil prices fall, the petrol stations have the incentive to delay restocking in the hope the petrol prices will keep on falling and they'll be able to restock at lower prices. So that's maybe the explanation. And if they've done that, then they've made a lot of money because gasoline prices have collapsed this week. So let's wait and see what happens. But one thing we know, oil prices had a terrible week, and markets can get things terribly wrong. So we've covered this over the last few weeks. This is the probability that the US government would shut down last weekend. And on Saturday, it reached 91% before promptly plunging to zero as a deal was announced. And on to economic data, Richard.
Thank you, Keith. So the UK S&P Global Services PMI this week is a little bit better than expectations, and it's sort of bumping along at neutral, which is where it spent a lot of its, it's not out of kilter with where it spent a lot of the pre-COVID decade.
Actually, so I should add some context here, Richard. This is the second and final estimate. And so previously, a few weeks ago, we reported it had fallen to 47.2. They've now revised that up to 49.3, which is still bad, but it's nowhere near as bad as it was.
Yeah, and it's not indicative of a recession, an imminent recession. Yeah. Well, it's not indicative of a recession, I should say.
Absolutely.
And the UK composite PMI looking very much like the services PMI, which is not surprising, given that our economy is 80% services.
Yeah.
Now, the UK current account deficit, although there was a small surplus in 2020, is looking typically unhealthy.
Yeah, look bloody awful.
Yeah. And quarter-on-quarter GDP growth in the UK. So it's been revised up, hasn't it, for quarter one, Keith?
Yeah, it has.
I mean, not a huge amount. Obviously, a lot in terms of what it was, but in absolute terms, the UK economy is growing very slowly. And there we have the year on year, where it's mildly better than expectations, but frankly, it's pretty awful, particularly if we're trying to grow ourselves out of excessive government expenditure.
Yeah.
Which we are, I believe, or certainly should be doing. UK consumer credit slowly inching its way up to the sort of higher amounts that we had in the mid 2010s.
Yeah, this is it's difficult to know whether this reflects consumer confidence, which I doubt, or consumer stress, and so they're having to turn to the credit card. That's what I suspect.
I mean, I suspect the same, Keith. I think you're right. I suspect it's stress. Also, I mean, we've had I don't know what the actual inflation, let's say, since 2017 is, but the consumer credit is at that level. These are absolute numbers. So if inflation since 2017 has been, I'm going to pick a number out of thin air, really, 30%, then to equate to the figure in 2017, it's got a long way to go.
Yeah, no, that's true.
UK mortgage approvals are basically in quite a strong downtrend at the moment. And I think that downtrend is continuing. I don't think this is a reversal of the downtrend. And UK mortgage lending, I mean, obviously, you would expect mortgage lending to lag mortgage approvals by about 3 months. So on the basis of the chart we've just seen, I'd expect to see that drop down below zero over the next couple of months.
Yeah, good point.
House prices month on month continuing to fall, and year on year down around about 4 to 5%, and showing no signs of stopping. UK global construction PMI dropping. There's an article in today's FT which says that house building is declining. And also we know that the HS2 has been significantly curtailed by Rishi Sunak, and that's going to feed through into UK construction PMI. So I think UK construction is heading down from here.
Yes, I completely agree. The UK houses are just unaffordable at these prices and these interest rates. And so I was reading about house building and how the supply chain was now slowing down. So brick makers were mothballing plants and making people redundant, and that is how a recession starts.
Yeah, and I'm guessing that a lot of the big house builders have expensive land banks that they're going to have. As prices fall, they're going to have struggle building out and making a profit. Well, what is this chart showing us, Keith?
So this is the breakdown of the UK construction PMI. As Rich has just stated, it's down to 45, massively missing expectations. And I'm just going to read this out. Output levels declined across the UK construction sector for the first time in 3 months during September, and the latest downturn marked the worst overall performance since the early stages of the pandemic. A rapid decline in house building activity acted as a major drag on workloads, with construction companies widely commenting on cutbacks to new residential development projects in the wake of sluggish demand and rising borrowing costs. Concerns about the domestic economic outlook also dampened client spending during September, which contributed to the fastest reduction in commercial building since January 2021. And you can see that actually the housing activity has been slowing steadily for a few months. What is remarkable about September is both civil engineering and commercial activity dropped very sharply. They had been holding up, and now they've started to contract.
The article in the FT today also said that a lot of the infrastructure projects that are sort of being planned are apparently being sort of incessantly delayed, and that sort of big contractors are going to struggle looking for work.
Well, we'll talk about this later, Richard, but in the context of bond yields, the rising bond yields put pressure on government finances. And in the UK, you can see that already having an effect. So I attribute the cancellation of HS2, etc., to concerns about government finances. And also, the Chancellor was talking about a ban on new hires in the UK government. So the civil service has 66,000 more people than it did pre-pandemic, and they've got to get that down. Now, so we can see government spending coming under pressure now.
Yeah. And rightly so, in the context of our conversation last week, where government is approaching 50% of UK GDP, it's totally unsustainable, and it's very damaging to the economy, and it has to happen, but it's very painful. I remember, I don't know how many decades ago, but I remember one of the, during one of the recessions, the constant mantra of job losses, job losses, job losses. And we are inexorably heading for that, but with a much bigger lag than anybody expected because of the fixed rate borrowing that we've discussed many times before.
Yeah.
UK new car registrations year on year. And actually they're looking relatively healthy, aren't they, Keith?
They are, but they're still massively lower than they were pre-pandemic.
Yeah. And one of the issues, I think, is that cars last a long time. So my car, I've had for 13 years now, and it's still going very nicely, and I have no intention of changing it until basically it wears out. It complies with the ULEZ rules, and I know car ownership's gone up, but actually the resilience of vehicles and the longevity of vehicles has also gone up very substantially. EVs and hybrids now represent 55% of new car sales. I don't really have a problem with hybrids. My problem with EVs is that we don't have the energy infrastructure to charge them all.
Yeah.
Okay, we don't have that many absolute numbers yet, but
actually, and various people on the Discord have pointed out, thank you, that MHEVs are really not EVs at all. They're just got a slightly bigger battery so that, the engine turns off automatically at the red lights and then they come back on again. So actually, instead of 55, it's really about, 38. But still, I mean, that's still very good. I think.
Yeah, no, it is, isn't it? But that's interesting.
And EV penetration has risen much faster than I expected.
Yeah, I think people like the concept, don't they, of gliding around an electric vehicle, not polluting, which is not polluting directly. Clearly, a lot of pollution goes into the production of the things.
Yeah,
but that is invisible pollution to the end user. So UK M4. Remind me, if you can, Keith, what is M4?
M4 is broad money. So it's like the broadest measure of money, including savings accounts, etc.
So that is slowly falling away from the very rapid increase it's had since 2016.
Mm.
And there we have a graph showing that UK M4 is negative year on year, which would suggest a reduction. You expect to see inflation falling and economic activity falling. So, I mean, I think we really are beginning to see higher interest rates biting, particularly in the construction sector in the UK, and then that will flow through to other sectors. And I think interest rates will be maintained at 5.25%. And for one reason, they can't afford to reduce them right now because of the exchange rate issue that would cause for the pound.
Well, also, Richard, do you remember that inflation is 6.7% still?
Yeah.
The Bank of England can't cut interest rates until inflation is, I would say, much closer to 2%. Yeah. And so this is exactly what causes a recession.
Yeah.
It's the lags in the system.
I mean, what's a realistic real interest rate going forwards? It's like 2%, isn't it? I would guess. And for the last few years, we've had negative real interest rates, and we are going to go back. Well, we're not necessarily going to, but a healthy economy would have a real interest rate.
Yeah, it would. Okay, thank you, Richard. On to the EU. So we had inflation numbers for the EU, and they were very good. So in September, inflation in the EU was expected to rise to 0.7% month on month because of the rise in petrol prices, but actually it only rose by 0.3%, down from August. And that meant that year on year, it fell very sharply to 4.3%, beating expectations. Everywhere, we are seeing pretty much immaculate disinflation. Core dropped sharply, but for the first time, and is still way too high, 4.5%, but much better than expectations. Now, if you look at the month-on-month numbers, then September was a shocker. It was minus 0.1%. So core is having deflation. And actually, if you look at the breakdown by country, you see that some countries, and the red dot is month on month annualized, which is a bit of a cheat, frankly, but you're seeing really quite sharp price falls. I mean, that annualized 5% in the Netherlands, and Dutch CPI is actually 0.2% year on year. So once again, you see the difficulties of trying to set one interest rate for all the various disparate countries in Europe. I mean, that Dutch economy is not doing well. And producer prices actually rose 0.6% month on month in September, meeting expectations due to the energy price rise. But year on year, that is an enormous fall, down 11.5% year on year. The unemployment rate, though, was steady at 6.4%, but they revised up the July number to 6.5%. So everywhere we are seeing Labour markets remaining tight even as the economy slows. Can that last? We ask ourselves. Retail sales in August in the EU were a shocker, down 1.2%, massively lower than expectations. Year on year, down 2.1%, again, well below expectations. The EU consumer is not doing well. The European construction PMI actually rose slightly from extremely poor levels in September, but it missed expectations of a bigger bounce, and that is bad. The Eurozone construction PMIs are consistent with a recession there. And something that I'm going to be doing every week from now on is the Economic Surprise Index, because I found a data source. And Eurozone has been in a long run of negative surprises, which have improved from their lows, but are still very poor and seem to be deteriorating again. So in summary, EU inflation is falling rapidly back towards 2% despite record low employment and interest rates that are extremely high and are going to continue to remain high until inflation falls back towards the 2% target. So I expect the Eurozone to be driven further into recession because inflation will only come down with a lag. On to the US, Richard.
Thank you, Keith. So the JOLTS job openings, it is basically continuing in its fairly sharp downtrend, I would say. I don't think that spike up suggests that trend has changed yet.
Very perceptive of you, Richard, because
75% of the beat in the JOLTS job openings was from professional and business services. Basically, I suggest that the job openings in manufacturing have fallen quite quickly, doesn't it, Keith?
Well, actually, this just suggests that this is a bad data point. So, because one thing we know is the JOLTS job survey, the reply rate has fallen to about 30%. So I think they just have to interpolate a lot of the data from a few data points.
Yeah. And the job openings index continues to show a decline. So the actual number of job postings is continuing to fall, whilst the JOLTS sort of oscillates around it, doesn't it?
Yeah.
And the JOLTS job quits is also declining quite sharply and continuing to do so, suggesting that people are reluctant to leave the security of an existing job. And it is consistent with continued fall in wages and salaries. So it's quite, actually, that is, I would say the correlation there looks pretty good.
Yeah. So later today, we have non-farm payrolls and wage growth. So let's see what happens.
Yeah. And firms appear to be not hiring as much as forecast, but they are retaining their workers. So the actual hiring rate is just continuing to drop from late summer 2021.
Yeah. For some reason, Trading Economics, where I get all the data from, do not report the hiring rate. They report the quit rate, but not the hiring rate. So this is interesting.
And the quit rate has dropped back to normal. If you remember, we had a very, very high quit rate a year or so ago, 2 years ago, with people hopping from job to job in search of pay increases, which they were getting. And now that has reverted to normal. And that suggests a slowing employment market. And the higher rate has been declining and is falling quite fast.
Yeah.
Challenge of job cuts, big companies reporting job cuts. Nothing particularly significant there, I would suggest.
Yeah.
And the US ADP employment month on month is falling.
Yes. Now, this was a big miss.
Yeah.
But we know that ADP has a very poor correlation with non-farm payrolls. So we're just going to have to see what happens this afternoon.
And also, we know that non-farm payrolls is highly manipulated. So the data source isn't necessarily particularly trustworthy.
Yeah.
US economic optimism index is falling quite rapidly, back to almost a low point in 2011.
Yeah, actually, Richard, before we move on, just talking about the non-farm payrolls, I disagree with you. I don't think it is manipulated. I just think that they basically have tried and model it, and their model of births and deaths for new businesses. That's a huge chunk of non-farm payrolls, and they can just be completely wrong, and they've been revising historic numbers steadily downwards. So
I used the wrong word, Keith. I didn't mean manipulated. I meant what did I mean? Model.
But this was a really interesting number. So this is the first number we have for October, and it's a survey of 900 US consumers, and that is a big drop, and that is at the bottom of its GFC lows. So let's see what happens in October.
And US inflation, PCE inflation month on month, 0.4%, which has actually risen quite significantly from where it has been since sort of late spring.
Yeah, I think that's rising oil prices.
Yeah. And PCE inflation year on year is, I mean, again, you couldn't say that sharp downtrend has been broken, but it has ticked up. So US core PCE inflation month on month is falling sharply.
Yeah.
All this year.
So the difference between the headline and core, is caused by energy and food prices. In this case, energy prices. If you look at core, that looks really good. Annualized 3 months.
Yeah. And this is a 3-month annualized core PCE inflation, which is coming down to close to 2% now. And the core PCE inflation year on year is at 4%, just below 4%, and falling quite sharply, continuing to fall sharply. So the core personal consumption expenditure price index changed from 1 year ago. You can see that core goods has fallen very sharply. Core PCE itself is declining gently. Core services ex housing also declining gently. And housing is, how basically we know about housing, don't we? Because of the way they measure housing, there's a huge lag. I think the interesting thing there really is core goods, isn't it?
Well, yeah. I mean, how sustainable is that? The worry is that core services ex housing is not falling fast enough and is way above the Fed's target. But I think a lot of that is just historic numbers. If you look at the last 3 months annualized, it looks a lot better.
Yeah. And services inflation is also slowing down.
Yeah. So when we talk about the previous chart, if you look at the last month, those numbers are coming down steadily, and the August print was a good one.
Durable goods prices gone negative again, or remained negative, in fact. So that is obviously disinflationary. Yeah, and we've got US personal income month on month, which is rising at quite a healthy rate, actually 0.4%, which is 5 and a bit percent annualized. And US personal spending month on month is actually at about the same rate as the income is, 0.4%. The services PMI is it's just above neutral, and it sort of seems to have stabilized between 50 and 55 now. And the services employment also seems to have stabilized.
Yeah, no sign of a deterioration, actually.
No. And services new orders is falling. I mean, it's in a very choppy, noisy downtrend. And services prices paid, that sharp fall has possibly stabilized a bit now. And factory orders better. And much better than expectations as well. I mean, we do have to remember there's an awful lot of money going into manufacturing plants.
Yes.
through government subsidies, government funding. The US Chicago PMI is nicely below 50.
Mm.
And the global manufacturing PMI is around about 50.
Yeah, that was revised up.
Yeah. And the ISM manufacturing PMI for the US is now bouncing back up. And ISM manufacturing employment also bouncing back up. So none of these these data points are suggesting the US is in a recession.
No.
Manufacturing new orders is back up to nearly 50. And manufacturing prices are still low.
Yeah, that's a good point.
Yeah. Construction spending month on month. I mean, if you take out that May oddity, it's pretty stable this year.
Yeah, not falling.
No. US Logistics Managers Index is showing, I would say that is a break of that downtrend, which is consistent with the manufacturing data. Red Book retail sales, pretty stable around 4% for the last few months. Credit card data suggesting that consumer spending is slowing, but it's slowing to at a very slow rate, and it's a very noisy graph. Yeah. I don't know whether there's obviously some seasonality in here with Christmas and so forth.
Okay. If you're interested, please pause and take a look. This is credit card data. And what it shows is that actually there have been some really sharp falls recently. The dotted line is 4-week average in particular categories. For example, food, total retail and food services, health and personal care, etc. Pause and take a look. It seems to suggest that recent drop does suggest that there is a weakening in the US consumer. And this is the data. Remember, the data we reported is for August. And these charts suggest that something happened in September. And this breaks it down by larger categories. And the one I'd highlight is travel and entertainment. And now at the start of the year, or earlier in the year, people were traveling and going out a lot more as the effects of lockdown persisted. But now that has entirely faded and people are going out and traveling less than they did last year.
The MBA 30-year mortgage rate is now climbing up towards 8%, as highest it's been since 2001 or so. And the US mortgage market index, I think, is actually continuing to fall. It rather looks as if it's going to go well below 200. And the mortgage applications week on week is a very weak, if you'll forgive the pun, number.
Yeah.
And initial jobless claims actually looking quite healthy.
Yeah.
And continuing jobless claims not looking unhealthy. But we do have some warn notices that are starting to rise where bigger layoffs.
Yes. Now, but historically, you have had these periods where warn notices have picked up, but actually jobless claims have continued to decline.
Yeah. The Citigroup Economic Surprise Index is surprisingly positive. So basically the US market, the US economy is showing resilience through its jobs market, and through the services sector. But there's some data that the consumer may be showing signs of weakness with that credit card data. But we have yet to see any significant data that suggests the US is entering recession.
I agree. Because the other thing I'd say about that credit card data in September was the US services PMIs for September were decent. So I don't see how those two data sets are compatible.
No. We see this quite often, Keith, in these various data sets. You see contradictions.
Yeah. Okay, on to China. So we had the National Bureau of Statistics manufacturing PMI, and that showed continued improvement in the manufacturing sector, which has moved back into expansion, and that beat expectations. Non-manufacturing also rose, but not as much as expectations. So that meant the composite beat expectations and is decently above 50, but not massively so. So according to the National Bureau of Statistics, the Chinese economy is recovering. But we then had the Caixin private sector survey, and that showed exactly the opposite. So manufacturing, according to Caixin, actually deteriorated in September. And so did services. And this was a big miss. That's a complete reversal of the trend. It was expected to bounce and it continued to fall. So that led the composite to getting worse. So in summary, once again, there's a big difference between the official PMI and the private Caixin. The NBS is saying the recovery is strengthening. The Caixin is saying it's weakening. Now, I'm actually surprised the Caixin is allowed to say it's weakening. So let's see how long they're allowed to keep on doing that. And onto one chart. Now, the last couple of weeks have seen an enormous rise in US Treasury yields, and more on that later. But that tightens financial conditions, and it always leads to a financial crisis of some kind.
And interestingly here, Keith, that the peak is at the point of the crisis, which suggests that we have yet to reach a peak because we don't have a crisis.
No, I agree with that. Well, I think that a catalyst is needed to change the direction of bond yields. And I think it is too early to call a peak.
And I mean, the US banking system is still incredibly vulnerable to these elevating treasury yields.
So watch this space. Something's got to break. These bond yields have risen so quickly that lots of people, including me, have suffered enormous losses. And highly geared entities, that's going to cause severe stress. We just got to wait and see where that stress shows itself.
Yeah.
Now, thank you to one of our Discord members, Dr. McCullough, for making me aware of the Brave Butler Kelly indices, which are a product of the Chicago Fed and which I hadn't heard of before. And so what these are is the Chicago Fed is trying to get a handle on how the US economy is doing. And they are using real-time data. They've got using 500 data series to try and get a better view of where the economy is and is going. And this is the coincident indicator, and it's 0.3 standard deviations below zero. So that means the US economy is growing, but not growing as fast as usual, which seems about right. And this is the leading indicator, and it's falling sharply, but is currently at zero. Let's see whether it continues falling below zero. And actually, I'd say this has been a very good guide, So we've had this to my mind, a totally unexpected bounce, but actually they were predicting it very well, but it's now fading again. And onto US corporate interest payments. Now, we have been talking about this for a bit, that Albert Edwards, the perma bear, has been showing this chart from the national accounts data, which shows that US corporations have had falling net interest payments, even as interests have risen very sharply. And according to the latest data revisions, he seems to be right. So what appears to be happening, and we've talked about this before, is that large US corporates locked in low loan rates during the pandemic. And so their interest expense is not yet rising very much, but they're making much more on their deposits. And Microsoft illustrates that. So its interest income has risen while its interest expense has not changed. So that means you get this big fall in net interest payments. But reminder, smaller companies, they borrow from banks. They don't issue long-term bonds. And so their interest expense is going up sharply. And so you're seeing stress on smaller companies in the US, but not on larger ones. And onto Inflation Watch, Richard.
Thanks, Keith. So we've got some new data from the EU with CPI at 4.3%, which is falling, and of course CPI at 4.5%, which is also falling. And US Trueflation, 2.5%, and very gently on this chart, slowly dropping. I mean, it almost looks like it's stabilized at that point, doesn't it?
Yeah, yes.
US rental inflation has now gone negative year on year, and US M4 broad money is falling, which would indicate that inflation should also be falling. It says less money in the economy. And BRC UK food inflation measure was minus 0.1% month on month in September, which is good news if you buy food. And it's projected to continue falling on the basis of the World Food Price Index for a while at least.
And I noticed wheat prices continue to fall.
Yeah, that's right. So EU wage inflation is falling, and it's around about 4.5% now.
Yeah, still too high, I'd say.
But falling.
But falling.
Yeah. And we've got a generalized falling inflation everywhere, as they say. So watch this space with regard to what central banks will do.
Yeah, well, they're going to have to keep monetary policy tight, frankly, because inflation is still too high. Wage growth is still too high, but everywhere you're seeing disinflation.
Yeah.
But they can't. I don't think they can start cutting interest rates until inflation is close to the 2% target. And onto the bond route. Now, we have seen a massive rise in global bond yields led by the US. And if you try and decompose what's going on, as Adam West has done on Twitter, you'll see that you can break the yield down into the term premium, the amount that 10-year bonds can be explained by interest rates over that 10-year period, and you'll see that the term premium has now gone positive, having been negative for a long time. Inflation expectations have risen, but not by that much. They're about 2.36%. But what's really driven the rise in bond yields, according to this analysis, is rising growth expectations. And growth expectation now at 2.3%. Now, that is very surprising because as we go through the data every week, clearly the global economy is slowing, and you'd think that at this point, growth expectations would be falling rather than rising. And so essentially what this analysis is doing is backing out those expectations and saying that in order to justify these yields, you would have to say that real GDP growth over the coming decade will be 2.3%, which is the highest it has been since pre-GFC and is frankly too high. So what it's saying is that bond yields seem to have become unanchored from reality, and something else is driving this rise in yields. and is just saying that the growth expectations are the highest in the last 20 years. And there is absolutely no justification for that. But, 2% real GDP growth is actually in line with historic averages. So not unreasonable, actually. But the bond rout has big consequences. So earlier in the year, we were talking about the failure of Silicon Valley Bank, and that was caused by the erosion of its balance sheet by losses on its holdings of US treasuries. Well, that's got worse. So all the banks are now sitting on big losses on their existing bond holdings and their loan books. And banks have been hit, but also insurers also have big bond portfolios. It has, though, been good for pensions because you can now get actually very good long-term positive yields if you buy UK gilts. More on that later. And junk bond spreads have finally started to rise, and they've started to rise really sharply. At last, the US bond market seemed to be appreciating significant default risks.
That's very interesting, Keith, because it's been puzzling why this hasn't happened.
Yeah. I would also say private equity is toast. So private equity relies on cheap debt to buy companies and then gear them up. That game is just over. So the effect of rising interest rates will be to increase the debt servicing costs of everyone with existing debt when that debt gets rolled over. And we've previously talked about how over the next year, about 1.4 million UK households will have their mortgages refinanced at these higher rates. All of that will continue to suck demand out of the economy, but also anything that requires long-term investment has become much more expensive. And so private equity is one, buying businesses. You can no longer afford to do that at anywhere near the previous prices of these interest rates, but also renewable energy and long-term projects, infrastructure projects. Their price has just shot up because when you could previously finance them at 2%, now you're talking about 8% or 9%. And so your big wind farms, which will require financing for years ahead, you just can't do it. And on to recession watch, Richard.
Thank you, Keith. So obviously covered some of the facets of recession a little bit earlier with the economic data. But so we've shown that whilst inflation is falling, we've got real rates continuing to rise. And that at some point you would expect the equilibrium to be restored. Mind you, when you look at this chart, the lines cross from time to time, but there's almost a negative there's not much correlation between the two generally, is there?
Yeah.
US consumers are not bullish, as this shows. So that suggests the economy might be slowing down, but
actually, I'd say it has a decent correlation, actually, because the economy has improved over the last year, and now it's people are concerned again.
Tracking employment is falling quite fast, and that suggests that there's a slowdown in the amount of goods being moved around the US, which suggests that the consumer and possibly construction is slowing, although we know that construction is being heavily skewed by the large amount of manufacturing plants being built. So with the increase in interest rates available, money is flowing into government bonds, which are offering the current highest rate of interest, and out of banks which can't afford to offer that rate of interest. And that is what led to the issues at Silicon Valley Bank and the others 6 months ago. And I would reasonably confidently predict that there's a lot of smaller US banks that are really struggling and suffering here.
Yeah.
And that assets they bought to hold temporarily on their balance sheet to provide liquidity, they can't now sell because they are not worth what they paid for them. Gradual increase. Goldman Sachs Financial Conditions Index continuing to tighten.
Yeah. Well, that's a big turnaround, actually.
It's done it quite quickly, hasn't it? I mean, it does seem to move. When it moves, it does seem to move quite quickly.
Yeah.
And US bank credit growth is negative, which means banks aren't lending into the economy because they either don't have the confidence to, or they don't have the asset base to do so.
Yeah.
And that's bad news for the economy. And the regional bank index continues to slide. It had a steep fall from 65 with the mini crisis that we had. It recovered a bit, and now it seems to be on a pretty steady decline. I saw a chart of the share price of Citibank or Citigroup the other day, and it is an inexorable descent to zero, one might think.
Oh dear. Well, on that point,
Metro Bank. So this is the share price of Metro Bank, and it's valued at it's down 98%, and it's trying to raise £600 million to survive, and it's quite hard to see how it might. I did also read this one is trying to sell 30% of its mortgage book.
Yeah. So on that, Richard, if you've got your money with Metro Bank, bear in mind the UK government only guarantees your deposits to, is it 80 grand?
Yeah.
Then anything above that, aren't you taking out? You could see this unwinding really very quickly.
Yeah. Yes. Banking system, I think, is not. So parts of the banking system are not very healthy. Pending home sales in the US at their lowest level since lockdown, and that is actually a pretty low level historically.
Yeah, no, that's really low.
And we are beginning to see what Keith and I have been predicting for too long, which is a slowdown in the US property market, in the US housing market. But of course, estate agents are hanging on as you would expect them to. It's probably quite a big lagging indicator.
Yeah, I'm amazed that their employment in the US estate agents has not fallen.
And the US triple B CMBS spreads are blowing out. In other words, people are very worried that the servicing of these things is going to fail. Yeah.
Expectations and defaults.
So European manufacturing PMIs bounced in September, but the bounce actually, if you look at the charts, the bounces weren't particularly big in the context of the noisiness of the charts, but are also all at a pretty low level. And the ASEAN manufacturing PMI is it's at 50, give or take. And the question is it going to fall below 50? Container shipping rates continue to slump, which suggests either there are too many containers or there's not enough shipping.
Or there's an excess of shipping.
Yes, and not enough being shipped.
Yeah.
Which suggests if the latter is the case, then clearly that's a slowdown in global trade. So it does genuinely it does look like global growth is slowing. The EU looks like it's slowing towards a recession. The UK does, and the US economy is resilient, but the housing market is starting to slow, I think, finally.
Yeah. Thank you, Richard. And on to the US construction sector, as Richard was just talking about, it finally seems to be slowing. Now, why has it taken so long? What this chart shows in the orange line is the total number of construction workers working in the residential sector, where the blue line shows the number of workers per construction unit under construction. And so the surge in construction, which was incentivized by the drop in interest rates during the pandemic led to the industry being unable to recruit enough workers, even though total employment grew by 10%. So the number of workers per unit fell from 2.5 average pre-pandemic to 2, below 2. So the effect of that is that construction is taking longer. So historically, residential units under construction tended to peak around 6 months after the peak in building permits, implying that new resi takes about 6 months, he says. But this time, it's around 10 months, and it still hasn't really started to fall, even though there has been a decent drop in permits. But at some stage, units under construction should follow permits down. It's just taking much longer because they haven't got enough workers, and construction is taking longer than it did. So that implies that a slowdown in US construction is coming. On to other charts, Richard.
Thanks, Keith. So this is a percentage of Chinese cities reporting residential building, secondary market price rises, and effectively it's very, very near zero. I wonder if there's one reporting price losses. Chinese real estate investment is negative year on year to minus 10%, which will obviously be a drag on growth and is not unexpected.
Yeah. Actually, returning to the earlier chart, Richard, you know, a few weeks ago, we showed that chart of price to income ratios for flats in China, and in Shanghai, it's like 50 times.
Yeah.
And the thing is, the only reason you'd buy flats at 50 times salary is in the expectation the price is going to go up as a speculation. And when the price is no longer going up, you know, surely the whole thing falls apart. So I think it's going to be very difficult for the Chinese to reinflate the bubble.
It's a Ponzi scheme. And the other thing is that going back to that chart of number of cities reporting price rises, I mean, what is the corollary of that chart? Number of Chinese cities reporting price drops, and one would expect it to be going up.
Yeah.
A Bank of Japan bond holdings, they own 40. They recently bought some more, didn't they? I think, Keith. So they now own 47% of all Japanese government bonds, and that's a lot.
Yeah, but you know, the thing is, been predicting a kind of inflationary spiral in Japan for a long time, and actually, the recent data shows inflation is falling again.
Graph of UK coal demand, which fell below its lowest level since 1757.
Yeah, amazing. Actually, the UK has done an astonishing job in the energy transition. You know, we should pat ourselves on the back.
Yeah.
So the last remaining coal-fired power stations due to close next year. And I personally think that if we can just get rid of coal, we get rid of most of our carbon problems. We just persuade China to stop burning so much, then, you know. Oh, yes. Well, good news. Okay, so the BBC had this week. On the top picture is the Caribbean island of Redondo, which had basically turned into an ecological disaster due to man-made actions. So we had introduced goats, and also rats had come with the goats. So the rats had basically predated on all the bird life there. Their eggs were being eaten. And the goats had just eaten all the vegetation to the extent that the goats were starving to death. There is an analogy there between Redondo and humanity and the globe, Richard.
There is, Keith. There is.
Anyway, yes. So now they have rehabilitated it. They've taken all the goats off, and they have, over a period of years, managed to trap and kill all the rats. and the lower picture is now. And, we managed to restore the habitat. Birds have come back. Plant species have increased from 17 to 88. So great news.
Good, isn't it? Yeah.
What can be done? But one off this week. It's been a bad week, but we have some bad news because Germany are reopening some coal plants. It's just, Germany as at the forefront of the green transition have just messed this up astonishingly.
They've made such a mess of it, haven't they? Such a huge, foolish, such a. I mean, it's just. But I'm basically, it's negligence, isn't it? It's not incompetence even. It's negligence.
Well, it's the fact they've closed down the nuclear power stations.
Yeah.
It's just idiotic.
Yeah, I mean, it was so grotesquely foolish. It was obviously foolish at the time.
Yeah.
What can you say?
What can you say? But good news, I thought this was absolutely amazing. The UK is now using less gas than it was at the depths of the pandemic. Our green transition is going incredibly well. And on to equities, Richard.
Thank you, Keith. So the FTSE World Index, as stock markets last week had a pretty rough time. So down 1.4% on the week, and now only 6.7 year to date. And we'll see that reflected, I think, in pretty much all of the indices coming up. So the FTSE all share down 2.1%. The Euro stocks down 1.8%.
I'm still amazed the Euro stocks is up on the year, given that we know how badly the European economy is doing.
Yeah, I mean, I agree, Keith. And also, the returns on the dividend returns, the comparatives just totally changed. So valuations haven't caught up with the current interest rate expectations. S&P 500 down 1.3%. I think the Nasdaq probably wasn't down very much, was it? That's my guess.
You're right.
Yes. So US tech holding up remarkably well and up 26% year to date. If only, eh? The Russell 2000 down nearly 4%.
Yeah.
Regional banks?
Well, basically, US small companies. And we know their interest expense is going through the roof. And you would expect that something we've covered is that the rise in, so the US consumer now faces headwinds from rising debt interest payments and also the start of student loan repayments, and Californians, Georgians, and people from Alabama, whatever you call them, Alabamans,
Albanians,
have to pay their 2022 tax bills, which they've been able to defer until the 16th of October. So there are lots of pressures on the US consumer. All of that will affect consumer spending.
Very true, Keith. Yeah. So Hang Seng was up for the week, but it's down 12% year to date. And the Topix was down a chunky 3.5%, but still up nearly 20% for the year. And Bitcoin. So Bitcoin has had a little bit of a run up in the last few weeks, and 1.1% last week, 66% year to date.
Yeah. I will be fascinated to follow the Sam Bankman-Fried trial. It's amazing the resilience of Bitcoin, actually, given all the shenanigans about all the exchange failures and frauds over the last couple of years.
I mean, the Bankman-Fried stuff it's just, you couldn't make it up. If someone wrote a fiction, you just say, "Oh, this is ridiculous."
Well, the fact he was the head of this effective altruism movement, and he was planning to give it all away and save the world. Well, actually, he was just defrauding everyone. Amazing.
Yeah, and he was giving away other people's money.
Yeah.
It's like the whole thing's. and he's giving a chunk of it to the Democrats. They seem to have avoided that so far. So the pound is pretty much unchanged year to date, and it's been pretty choppy, hasn't it?
Yeah.
Up, sort of not far off 10% at one point, back unchanged, and the euro is down year to date, down on the week, and that's been less choppy than the pound, but quite choppy. And the dollar index, of course, is doing very well, and it is causing quite a lot of stress, I think, in the currency markets generally.
Yeah, but also any foreign companies with dollar debt, that's not good for them.
And indeed, any foreign countries with dollar debt.
Yeah. Also, any US corporations with foreign revenues, that's not great. So, everyone's expecting US corporate earnings to keep on rising. There are a lot of pressures on corporate earnings, I'd expect.
Yep, I agree. And the VIX surged through 18. And there's, what was the buy level, Keith? Was it 20? Or was it that way you put the line?
No, the sell level was 20.
That's right.
So when the VIX goes below 20, the markets are complacent. You buy it above 30. It's just amazing how subdued VIX is. So according to VIX, markets are still you should be sold.
So the fear greed index is moving into extreme fear.
Yeah, not convinced.
No, I'm not either. Actually, I mean, the small movements there are relatively small movements in the market year to date is still significant. They're measuring the wrong thing. Well, maybe,
yeah. I know this has been all over Twitter this week. The kind of correlation between the S&P 500 now and in 1987. Well, we'll see.
Yeah.
But rising yields should be very bad for equities. And at some stage, either bond yields have to fall or equity prices have to fall. Yeah.
I mean, all the correlations have been broken by central banks, haven't they?
Yeah.
That's the problem. You can't really use these correlations anymore because QE, ultra low interest rates, has all messed it up completely. So we have here operating margins for US companies are under pressure. And so the Russell 2000, I mean, so actually the Russell 2000 not that much under pressure, is it? And they're all declining, fair comment, but actually none of them are particularly below their last 10 years. If you ignore the COVID, none of them are particularly below their last 10 or 12 year, their last 10-year average.
Yeah, but, the trend is not a happy one.
No.
Thank you, Richard. On to commodities. And it's been a dramatic week in the oil market. And frankly, who would have thunk it? I mean, really, last week, everyone was, including me, was expecting a tight oil market to lead to oil prices heading towards 100. Instead, it's completely reversed course and fell 12% in a week. And WTI fell 11%. I mean, these are big moves, actually. Very good for the world economy. Now, if we turn to data specific to the oil market, well, again last week, we saw a crude build in the US. So including the SPR, almost 5 million barrels. So it does suggest that the US oil market is well supplied. Though the Baker Hughes rig count fell by 5. US crude production is at its high for the year of 12.9 million. Now, this is a long-term forecast from JP Morgan, and they are not buying the energy transition, frankly. They think that the world oil market is going to go into serious supply deficits in the coming years, particularly from 2025 onwards. So let's wait and see. That seems quite a long way off right now. But, whenever people say that the oil market's going to go into, prolonged deficit. I mean, that just can't happen, because you eventually run out of oil in storage. So supply and demand must, by definition, be in balance most of the time. And if you look at this chart, shows that they are. So prices rise to the point at which you destroy demand to bring it back into line with supply. Now, OPEC were positioning themselves for a 2 million barrel a day supply deficit in Q4, and hoping, this is from earlier in the week, that oil prices were going to shoot up above 100. Well, this forecast has not survived the week. I put this in on Tuesday, I think. But Asian crude flows, blue bars, fell again in September. So, how much of that is refinery maintenance, and how much of that is actually higher prices causing demand destruction? But the one thing that is absolutely true about the oil market is that inventories are really low, because the Biden administration has sold down the SPR, and it now only has 17 days worth of US consumption, which is half its long-term average.
Yeah, also I remember saying a few weeks ago that by draining the SPR from the underground caverns, it's causing damage to the underground caverns, because the hydrostatic pressure of the oil was holding the walls up.
Yeah. Well, I think Biden sold the crown jewels, hasn't he?
I believe so.
Yeah.
He's exchanged it for, I don't know.
Yeah, for what? For a slight drop in the oil price for a few months.
Yeah.
Anyway, good news is that we are having a mild autumn so far, and EU natural gas prices fell by a best part of 10% last week. UK natural gas prices fell by 12%. Fantastic. Let's hope that continues. US natural gas prices, on the other hand, rose by 8.5%.
But why that discrepancy, Keith? Do you know?
Honestly, mate, not sure. No, not sure. I wonder whether the very low prices earlier in the year discouraged drilling, and that's finally showing up.
Yeah.
Coal, suspicious of this data, frankly. That looks like a bad data point to me. But anyway.
Yeah.
Uranium going to the moon.
So can I just chip in here? I was listening to an interesting little webcast. Actually, it was, I can't remember his name, but it had Cuppy on.
Oh, yeah. And
Cuppy is very bullish on uranium. And basically, he was saying that the supply-demand information, the supply-demand state simply mandates that the price has got to go up significantly. And it wasn't a detailed conversation, but he also said that there's some sort of management of the pricing by the big utilities, because it obviously benefits them to have keep the spot price low, and they can do it by buying long dated contracts and then selling short dated contracts, which keeps the spot price down, but it doesn't affect the supply demand dynamic.
Well, anyway, the trend looks like Cuppy's right for now, until all those all those shuttered mines come back into production, Richard, would be my suggestion.
So cynical, Keith.
And industrial metals, Richard.
Thank you, Keith. I think probably the industrial metal charts look pretty boring, I suspect, this week, as they have done for a while. That was a big spike up by aluminium, followed by a big drop down. Who knows why?
Yeah, well, but that's a big reversal in the trend. Last week it looked like aluminium was recovering. This week it don't.
Yeah. There we have. I wonder whether we should discontinue cobalt for the time being.
Yeah, Well, it's in there, but you're right. We should just skip it.
copper is looking like it might break down below that 350 level. It's down 7% on the year, had a bad week. I mean, it's not going to be helped by the Chinese property market. But you would think that the demand for copper should be continually increasing with electrification, which is now firing on all cylinders.
Yeah. However, Richard, I would also say that, we've talked about this, but copper going into deficit long term because of renewable energy. So, you need for a wind farm or a solar project, you need just vast amounts of copper.
Yeah.
But rising interest rates mean that, wind investment is just totally uneconomic and will just stop now. So you can see short term that copper demand could, be disappointing.
There's a lot of headwinds against it, aren't there? I completely agree. Chromium doing not very much, really. Iron ore actually not doing very much either.
Yeah, that looks like a bad data point to me.
Yeah, flat. Lithium, I mean, it's in a downtrend at the moment, isn't it? And it hasn't broken out of that downtrend. Didn't really go anywhere last week.
Yeah. Now, actually, when we talk about bad data points, you'll notice that I think all the commodities that are reported from China, like lithium, we do not seem to have had an update this week. I think there's a big holiday in China.
Right. Neodymium, no data there.
Yeah.
Nickel is continuing to decline, actually, and it's down nearly 40% year to date, which is a big, big drop.
Yeah.
Tin, which has had a bit of a bit of a bad week, but it's only 3.6 down year to date. Ferrovanadium, that just looks to me like ferrovanadium batteries are not going to happen, or rather vanadium, whatever they call batteries, aren't going to happen.
Yeah.
And because of the decline in the Chinese construction market has to influence steel demand, which is one of the big demands for vanadium. Zinc is not having a good year, down 17% for the year. The big jump up in September, followed by an identical pretty much drop down.
So we saw a bounce in manufacturing PMIs as reported this week, but commodities are rather implying that that's fading, frankly.
They are. Precious metals. So precious metals, gold had a poor week, falling to nearly 1,800, down 5.5% on the week, which wasn't very good news for me personally. And central banks still buying lots of gold. I think as with stock markets, the price of gold has been influenced significantly by the strong US dollar and also by interest rates, the rise in interest rates. Notwithstanding that, I still think gold is a good hold. And silver, which is always more volatile than gold, down 7% for the week, and now down 12.5% for the year. Platinum also had a bad week and down 20% for the year. This presumably means there's demand. I mean, if 50% of vehicles are effectively EVs, it's not quite true, but that has to have had a big impact on the catalytic converter demand.
Yeah.
Rhodium doesn't look like there's any data coming through.
Yeah, no, I did check this because we've had no updates for so long. I was thinking, I did check various other websites, and they all showed the same pattern. So I think maybe the rhodium market is just dead, frankly.
Yeah. Palladium, which is also a big catalytic converter metal, same problem as platinum, but down 36% for the year. So these the miners of these precious metals are going to be platinum group metals are presumably are really struggling. I don't know because I haven't looked.
Yeah, toast. Okay, and on to rates. And it was an absolutely terrible week for bonds. So once again, the yield curve moved up. And so the blue line is current UK yield curve. And the dotted line is where it was a month ago. So over the last month, we've had a dramatic move up in the yield curve, and nothing compared to what it's done over the last 6 months. And if you look at the center of the curve, the 30-year is now above 5%, which is, and if you believe that the Bank of England is going to get inflation back to 2%, that is an enormous yield premium. Current UK interest rates are 5.25%. Now, everyone agrees that that is contractionary, that those interest rates will slow the UK economy. And you can see that in the housing market, where, you know, house builders are basically cut back their house building by, I believe, 40-odd%, and housing is just unaffordable. Now, the market is implying that for the next 30 years, interest rates in the UK will average 5%, which are contractionary. And the UK, I continue to believe that the UK economy just can't support 5% interest rates. When all those mortgages are refinanced from their current 2% to 5%, a lot of demand gets sucked out of the economy, and the UK economy will fall into recession. So I think current interest rates are just daft, frankly. But obviously, and we'll go on to this in a bit, I have got completely stuffed on my bets in long-term bonds. But I don't think these rates are sustainable. Could they go higher? Yes, of course they could. But I think they've become unanchored from reality. The US has gone even worse. The US in the 20-year is now well above 5%, and that is an enormous move over the last month. Now, when the Fed pauses, it pauses because it thinks that the interest rates it has imposed on the economy are sufficient to slow the economy and bring inflation back down towards the 2% target. And normally, at that point, government bond prices begin to rise in the expectation inflation will come down and the economy will slow. This time, bond prices have done precisely the opposite, and that has caught me in particular totally by surprise. And the volatility of the bond markets has just been absolutely off scale. I mean, this rise, we were talking earlier about how rise in interest rates generally causes a crisis of some kind. Well, the speed with which the bond yields have risen is also important, because that doesn't give highly leveraged entities enough time to react to reduce their positions. So I fully expect that people will have been caught out. Highly leveraged entities will be suffering severe losses. A crisis of some kind, I'm sure, is coming. And that made long-term bonds the worst performing asset in Q3. And discussed this earlier, but renewable energy just does not work at these prices, because you're talking about, frankly, investing a lot of money in very low return assets. And when the bond yield is higher than that return, it doesn't work. And so clean energy indices, equities have had a very bad run. Expect that to continue. So one of the reasons that people have been saying that US bond yields have been rising is that China has been selling down its positions. Well, that I think is not true. This is a very complicated chart, but if you're interested, pause and take a look. What it essentially shows is, yes, China has been selling its long-term treasuries, and that's the bright green bar, but it's actually been adding to its offshore holdings of US bonds. Now, I think the reason it's doing that is its direct holdings of US bonds, if it were to fall out with the US, could be seized quite easily. Whereas its offshore holdings, which are held in ETFs or whatever, offshore in Belgium, much more difficult. So China is not selling down all its holdings, it's just holding them in more secure locations. Now, this is the US 10-year, and you see it had been in this channel, and it has got its blown out of that. Absolutely shocking. Now, I essentially bought it when it broke out of the higher channel around here, and I have been absolutely taken out. But I just don't think these are sustainable. So at some stage, I think it goes back into the channel. In fact, frankly, I think it's going back towards the red line. Other people will be saying this marks a break and we're going to the moon. There was somebody on Twitter saying that US 10-year yields are going to 13%. Well, I just don't think that's possible. The whole world would collapse. So everyone, well, lots of hedge funds are short US Treasuries. Now, the reason that we had such a rout in oil prices this week is that everyone was long. And so when crowded trades unwind, they unwind very quickly. So, but short term, who knows what's going to happen with bonds. And this is the iShares 20-year plus US bond ETF. It's had a shocker, but it's seeing huge volume. Lots of retail clients are buying US Treasury bonds for the yield, which is, compared to what you can get previously, very high. And inflation's coming down. So looks like I continue to think the bonds are a very, very good long-term investment at this point. But we've talked about this previously. It seems to me that the bond vigilantes are back, that market is concerned about the sustainability of US debt. In one day yesterday, an average day, the US issued around 33 billion in debt. So the 2-day total is 308 billion. So it's issued, just bond issuance in the US is just absolutely enormous. Now, the problem is that during the pandemic, when interest rates were very low and long-term interest rates were extremely low, most governments in the world, including the UK, issued long-duration bonds and extended their maturity profile, locking in long-term low interest rates. The US didn't do that. And so it has an average maturity of around 2.6 years. That means it is continually having to refinance existing bonds at these new rates of around 5%. And if that continues, the US deficit will explode. We know the US government is currently in a state of dysfunction because they have this temporary agreement that funding it till November the 17th. The US Treasury will be aware of these debt dynamics, and you would expect them to have to do something to address market concerns about debt sustainability. We can only just wait and see what those measures will be, but they need to do some. Now, the term premium. Now, the term premium means the price, the yield of 10-year Treasury bonds compared to the sum of interest rates over the next 10 years. And it's moved positive for the first time in a couple of years. Now, why is that? Well, the FT offered some explanations. Expected higher interest rate volatility? Yeah. Inflation volatility? Yeah. Uncertainty around US solvency and political stability? Yeah. Treasury supplies rising sharply? Yes, but, and actually I'm going to do something on this next week. actually the week after, most of the rise in the US deficit is actually due to inflation. And if they get inflation down, the deficit will come down if they can bring bond yields down. Anyway, pause, take a look. So going through some charts, UK 2-year. So interest rate expectations in the UK for the next 2 years are not rising. They have peaked. So the market thinks that UK interest rates are high enough to bring inflation under control in the short term. But the 10-year has had an absolute shocker over the last month. And the 30-year, that's been devastating for me. New highs. So long-term bond yields have followed the US higher, even though UK inflation, market expects it to be coming under control. Now, if you look at the US 10-year, that is still on an upward trend and looks awful. The German bond yield has not coming down, despite the fact Germany seems to be once again threatening to impose its, what's it called, the hard black budget balance requirement, so that during a recession, it will keep the budget in balance. The Italian 10-year still rising. Greek bond yields, mainly held by institutions, actually not following Italy higher. Any change to your views, Richard?
I'm no. I mean, I'm nervous. I'm nervous about bonds just because I think the market has been so distorted.
Yeah,
very difficult to very difficult to rationalize what might be happening because could be so much going on underneath the surface.
Mm.
I mean, I agree with the principle of your analysis, but I'm nervous that there's stuff going on that is impossible to determine.
Yeah. Okay, concluding comments. Well, the bond vigilantes are back. Governments will struggle to finance themselves if bond yields remain at these levels. And so, as inflation comes under control, they will need to address bond yields and concerns about sustainability, in particular, of the US deficit. So watch this space. How was your week, Richard?
So it wasn't a great week, Keith, because obviously my exposure to precious metals has been, and they were knocked a bit during the week. And actually uranium got knocked as well. Price of uranium.
Really?
The uranium miners also got hit. But I'm confident in my thesis, so I'm just sort of sitting on my hands, continuing to do nothing. I did notice I have a small holding in Diversified Energy, which we covered a long time ago. They've been doing share buybacks, and they're exposed to US natural gas, basically. And they are now yielding, had a very bad week, they're now yielding about 20%. Yeah.
I also hold DEC, actually. I noticed that. They came out with a statement this morning saying they noticed the fall in share price and reiterated they know no reason for it and they're continuing share buybacks. Who knows?
Yeah, I'm holding those. How about you, Keith?
Well, I'm afraid I had an absolute shocker as global bond yield sold off. And I'm having an absolutely dreadful year, down best part of 20% and probably not over yet. Now, I have been absolutely completely wrong, and I've been completely wrong in very big size. I take a lot of risk and I follow my judgment. And, in this case, the sell-off in government bonds has totally taken me by surprise, in that you expect when inflation comes down and the economy slows and you see the peak of interest rates is in sight, bond yields start to fall. Instead, they have shot higher. And I'm not convinced by any of the explanations. The only thing you can say is that there are more sellers than buyers, frankly. So perhaps it is the fact the US is just issuing vast amounts of debt, and that is leading to contagion all around the world. Now, I did actually do some buying last Friday. I had sold my gold, which turned out to be a decent decision. But then, frankly, I thought I need to be brave. And I bought the 2050 index-linked gilt, and that is yielding the best part of 5%. And it implies inflation of 3.37% and 1.6% real. Amazing. And that would be essentially be largely tax-free. So hold it to maturity, that'd be very good for me. I bought it at 79.5. It's immediately gone, lost best part of 5%. Not much fun. Now, let's talk honestly about stress, because I am frankly very stressed out about this. I've lost a lot of money. I'm looking very silly. I'm feeling, pretty silly as well. I mean, the thing is, I take back my own judgment. The markets have been very good to me over the years. I've made a lot of money, but I've given up a decent chunk of it over the last couple of months. Now, the thing is, to me, stress is part of the game, and you have to be able to live through these periods, because the worst thing you can possibly do is capitulate because you can't stand the psychological strain. So I spend actually quite a lot of time thinking about my own mental health and how I manage myself to be able to survive these periods, because I continue to believe that UK economy cannot survive interest rates at 5% for any long period of time, because it will simply mean that all forms of investment, including buying houses and green energy, just become unaffordable. Therefore, these interest rates will drive the UK economy into a deep recession. So to me, it's just a question of holding on. Could it get worse? Yes, it probably could. And there's no reason to believe that we are at the peak of these bond yields. And I've lost a lot of money, and it does stress me out. But the good news, the one thing I've got right, is I don't have any gearing. So nobody can take me out of this trade apart from me. And yes, I'm very stressed out about it, and I shouldn't watch the screen all day, but the reality is I do. But you've just got to get through it. So not feeling very clever. When I started this podcast, I was an absolute high. I'd made a lot of money, and I was very confident. And frankly, part of the reason I'm in this state is that I was massively overconfident. But, ho-hum is part of the game. And a friend of mine was asking me, what I was going to do, how this is going to change my behavior going forward. Would I take less risk? Yeah, possibly. But this is kind of, this is part of the game. You have the lows, you have the highs. If you want the big highs, you have to risk the big lows. And this is a big low. So, no one to blame but myself. Now, let's talk about Gulf Keystone Petroleum and Genel Energy. Now, the Ceyhan oil pipeline reopens this week, good for oil markets. And you remember that we talked previously about 2 UK-listed oil companies with operations in Kurdistan. And now they should be able to restart proper operations and export all their oil. So the share price of Gulf Keystone has bounced over 20% in the last week. I would really caution about going in too early to both Genel and Gulf Keystone, because the new deal is that the oil will be sold by the Iraqi central government, and they will then remit the money to the KRG, and the KRG will pay the oil companies. Now, previously, we know that Gulf Keystone was having trouble getting paid on time by the regional government. The regional government will not have had oil revenues for 5 months, and therefore will have suffered big budget deficits. Who knows with what lag they will pay Gulf Keystone. So I would wait to see what terms and how long it takes Gulf Keystone and Gunnell to get paid before dipping my toe in either of them. Okay. Richard, anything to talk about stress and whatever?
Yeah, I think you're quite right. It's really difficult. If you don't take risk, then you don't get the rewards. If you do take risk, then your volatility goes up, and volatility on the positive side is fantastic. Volatility on the negative side is mentally exhausting.
Yeah,
but it is part. And the other thing I'd say is you have to have confidence in your own thesis. It can't be someone else's thesis. So if you adopt someone else's thesis because you think they must be right and it starts to go wrong, because you haven't actually rationalized it all yourself, you will be much more easily shaken out of the position, even if it's the right thing to be in. So I always feel that you can take on board what other people say and put it as part of your own model, but you mustn't take it as gospel, because you actually won't have conviction at the time when you mustn't get shaken out. And that's, I think, that listening to people recommend things is interesting, but you shouldn't just go out and buy what's recommended without really understanding and agreeing with the thesis.
No, absolutely. I hope everyone watching this, we've got a couple of disclaimers, but you make your own decisions. And I know a lot of you disagreed quite rightly with my thesis. But I always back my own judgment. I back it in size. And, this time I've been completely wrong. But that doesn't mean I'll necessarily close out this trade at a huge loss. I'm still pretty hopeful. Actually, I won't, frankly. So, it's pretty nasty, but the world economy doesn't work at these interest rates. So, just got to stick with it. Not much fun. I hope all of you are doing much better than me. It would be difficult to do worse. Anyway, we are back in 2 weeks' time. So in the meantime, please can you press like and subscribe to the channel. And it's goodbye from me, Keith Jordan. And it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.